So let's just start with the first topic, or the entire yields question. Uh, do you think it's going to be a problem? Because consensus expects yields to be higher in the coming months. I mean, the pace and the quantum differs, but by the end of the year, most agree that yields will not be where they are right now. Your thoughts?
Yes, I'm also of the view that the yields are definitely going to be higher. The real problem is not just the fact that the yields are at whatever 1.4 or that they might trend higher. The real problem here is that the world has gotten used to, for the last, I think, whatever, 30, 35, 38 years, that the US Federal Reserve is blessed with some extraordinary godlike powers. And I was on a show with some mutual fund people some weeks back, and the consensus from every CIO I heard was that leave everything to the Fed. We don't have to worry about anything at all. Just leave everything to the Fed. They will take care like a loving mother, with a little child, which is wailing occasionally. So I think we need to reconsider that now, because the pace of the balance sheet expansion, the pace of the stimulus, the quantum of the stimulus is absolutely staggering this time. It is just of an order which has not been seen for the last 70 or 80 years. By any estimates, you're looking at a 30 to 40% of GDP number in terms of the overall deficits being run by the United States of America between the between the current account and the budget deficits. When you have deficits of that kind, you cannot expect that there will be no side effects. How can anybody say that it's like a costless stimulus that you can keep stimulating and there is no cost or there is no debit side to it? The markets are forcing the Fed's hand. That is what is happening here. The yields are nothing but a symptom of the underlying problem, which is this time you've gone out too far. That is effectively what the market's message is. So coming back to your question, yields will trend higher. Standalone, they may not have been a problem, but when you juxtapose that with sky-high deficits on the current account and on the internal fisc for the US, right? In some senses, India is also similar, but let's not go there right now. And the second side effect is getting borne by the currency, which is the US dollar, which is fallen sharply in the last, 5, 7, 8 months time versus all major currencies, not so much against the dollar, I'm sorry, against the rupee, but against the Taiwanese dollar or, the won or the euro. When you see both of these things together, which is rising yields, falling currency, and a sky-high deficit situation, that is where the problem lies. So I don't think standalone, it's a problem that yields are rising. I think when you put all the jigsaw together, it's a Molotov cocktail. It is not a normal cocktail. It's not a mojito. It's a Molotov cocktail.
So, Shankar, you've identified the problem for us. Global yields will rise. There is a ballooning fiscal deficit. The currency is falling. But what is the implications of all this, from a market point of view? And then when we see it in context, even in India, the domestic yields are rising. Will it hurt the growth story?
Look, I mean, I've always believed that at some level, markets are pretty simple. Low interest rates mean typically higher equity valuation and therefore higher equity prices. I mean, that's pretty much what the seesaw of investing is. In India, from the time I entered the markets, which was late 80s, we were used to very high interest rates. In the mid teens, companies like Tata Motors used to borrow at 18, 19% in the 90s. I remember. And therefore, equity markets did nothing for 10 years. It's only when yields started to crash, and around 2004, I think they went down to as low as 5%. You saw a massive bull market in India when we compounded 55% for 3-4 years up until 2008 January. There could be a repeat of that kind of return spectrum, provided yields in India remain around 5 or 6% levels. But if they go to 7%, 7.5%, we have a problem. So in a lot of senses, we have also expanded our balance sheets in this current budget, quite remarkably. And I think it was necessary. But again, there might be a side effect to this. And the side effect could be rising bond yields because of the pressure on the borrowings that the government is going to exert on the debt market. So if you were to believe that yields in India go to 7.5, and we have a second problem too, which is rising commodities, which I think Prashant has mentioned is another point to be discussed. If you juxtapose the two things, we need to be a little careful. Again, I'm not of the camp, as most fund managers are, that we just look at only one side of the picture, only the asset side of the picture without any liabilities, or look at only the profits and none of the costs. In investing, one has to look at both. There are acceptable problems and there are acceptable risks, and sometimes there are unacceptable risks. But we need to be mindful and cognizant of risk. There is nothing called a risk-free world, that there is no problem, there is no concern. These are some of the concerns which I've just mentioned and surfaced on the global macro as well as India's macro.
You know, there's been explosive rise in the Fed balance sheet. There will be consequences. And as always, I mean, that time of reckoning, there have been people who've been calling this for 10 years now and have been wrong, Shankar, right? In terms of the fact that the market will force the Fed's hand and rates will, there'll be inflation and whatnot, right? But it's not happened so far. But you're right. I mean, post-pandemic, the way the balance sheet in the US has gone, or the Fed balance sheet is sort of ballooned, is unprecedented. Absolutely. Do you think?
No. Let me interject exactly there. I completely agree. Okay, so people will go back and say they did the same in 2009 and they kept doing it continually at various points in time in history. It's no problem, no inflation, no real macroeconomic collapse or problems, right? The trouble in markets is that when we all become fat, complacent, overfed on easy profits, that's a time when the market surprises. Right now, we are all fattened by easy profits the last 12 months or 8 months' time. We are all fattened by ultra cheap interest rates. We are all fattened by low inflation. We are all fattened by the belief that the Fed is God. I worry about these things. When I see so much consensus and so much overfed people, fat people skating on thin ice, I have a problem with that. Which is all I'm saying. I'm not saying the ice will crack. All I'm saying is, if I'm skating on that thin ice, I want to be very trim. I don't want to be fat.
Absolutely.
Because I want to be the first guy off that lake when the ice begins to crack.
Yeah, no, absolutely. No, the second part of my question, which I was just prefacing my question, I didn't get to the question. My question was, if this time the markets were to, in a matter of speaking, win and really force the Fed's hand, in terms of portfolio, where should one be? Should one be in, technology? Should one be in commodities, cyclicals, old economy, new economy? Where should, in terms of the equities world, forget asset allocation, in equities, where should one be?
So I can only tell you what we have done and what we have seen and what we have strategized in the last, several months. And thankfully, at least most of it has worked out quite well. So, we have been very, very light on at least the US tech part, right from September onwards. I think from April, when I was discussing the trade with my dear friend Madhu Kela, I remember one nice evening, maybe it was March end or something, when oil was in the teens. And I said that, look, forget about stocks. I think oil is a no-brainer buy. So, we've been long oil and commodities in general from late March and early April. And that has worked out as well. So broadly, I do believe that this whole rising yields, weakening US dollar bode well for commodities. And that's a trade, at least, we have been on from, pretty much April last year. So steel stocks in India, steel stocks globally, copper companies globally, mixed plays in India. So you have several companies in India, which, in ferrous, not, on the non-ferrous side. We played all of those. So I think that's a decent place to, again, please understand, this is my view as of right now. Okay, I'm a hare. I will change tomorrow if things change. So please do not take that as the gospel. This is where we are positioned right now. We could change tomorrow. With that caveat, we think, the markets are going to be worrying about inflation. If not now, I think in the very, very near term, future. And I want to be ahead of the curve by already worrying about it. And I worry a lot. And I'm a worrier by nature.
Okay, Shankar, we'll come back and find out more about your portfolio positioning. We need to slip into a commercial break. When we return, more discussion lined up on this commodity super cycle and how the Indian markets are faring in context with the global picture. Stay tuned for this exclusive conversation. Welcome back. In conversation with Shankar Sharma, the Vice Chairman and Joint MD at First Global. Shankar, you were telling us that you've already started worrying about inflationary pressures. What would this mean in terms of an Indian portfolio? Which stocks would you look at? Which stocks would you avoid, or sectors?
So, like I said, that we are already, pretty well invested in all the commodity sectors. Which not directly beneficiaries of core inflation per se, but they are really the harbingers of doom in a way, because the world doesn't like a commodity bull market. The world likes all bull markets. The world loves an equity bull market. The world loves a bond bull market. The world loves a gold bull market. But the world doesn't like an oil bull market, or it doesn't like a copper, because all those things make things expensive for us, which we consume, like a car or some power equipment where some copper wiring is used. So, but like it or not, I think those things are headed higher, and we want to be positioned right there. Therefore, if inflation perks up in India or globally, I think a very logical place to be in is in the rural economy, because it is in my belief, and I've said this publicly for decades, that country like India cannot run on ultra low inflation, because a large part of the population is in rural India, and the beneficiaries of inflation, by and large, are in rural India, because they are the people who produce the agricultural produce, which we all consume in the cities. And when those prices rise, while we don't like it, but rural India likes it. If you go back in time, the best years of rural consumption in India, and just since 2003-4, have been the time when inflation was around 9%, or even sometimes I think it was in just about at the cusp of a double-digit number, and rural consumption was explosive. So I believe that if inflation perks up, there are still ways to make money. One should not get scared. One should be in the rural end of the market. I don't want to take stock names, but there are ways you would be able to play inflation because of higher money being put into the hands of farmers is not a good word these days, I'm told, but in the hands of farmers.
Shankar, let's talk about, the global overlay, which of course has been dominant for a while now. How's the India story itself panning out according to you in terms of earnings growth expectations, which are building up, and sort of contrasting that with where valuations are right now?
Right. So here's the thing. I was just looking at some data, and for the first time in a fair bit of time, the dividend yield on the S&P 500 is now lower than the 10-year bond yields there. I think it's about 1.3 or 1.35%, and the bond yields are 1.5%. So now there is a negative yield gap. In India, we don't even know what a dividend is, because dividend yields are abysmal. So the way we look at valuations in India is simply a growth number. There is no concept of a buying yield in India, because there are no yields available. And when you look at the context of the market, a 5 or 6% bond yield translates into roughly a 20 times P ratio, just a pure reciprocal of that. Plus you add some growth, so the market can support a 25 times earnings, which is where I think you are right now, if I'm not mistaken, right? 25, 27 times on the Nifty. Now that's a delicate balance. It's very, very finely balanced. If yields go to 7.5%, okay, then suddenly your P multiple that the market can support purely on this arithmetic drops sharply to only 15 times. You see the point I'm trying to make? That at 5-6%, you are just about okay. Okay, moment you go to 7.5, simply on that metric, the market starts to appear very expensive. So unless, therefore, the compensatory factor is very, very strong earnings growth, which I think at least this cry wolf is probably going to have the wolf in a good way coming. Meaning we have cried wolf that the earnings are going to accelerate and improve for the last 6 years. We've been all wrong. Hopefully this time we'll all be right and we'll get some 20, 25, 30% earnings growth in 22. If that happens, we can still look at a 20, 25 times multiple. But if that doesn't come through, and this is just a flash in the pan, recovery trade, pent-up demand, and it just kind of tapers off a few months down, then we will have a problem for sure. And the other big problem, remember, is oil prices. I mean, that's your old bugbear from the time I have been born. The only problem India has had is कि बेटा सब कुछ ठीक है, लेकिन oil is very high. And if oil goes into this so-called super cycle that all the strategists and brokerage firms are talking about, then our booze is cooked. Because if you have rising bond yields, which will again be a corollary, an outcome of higher oil prices, because you will need to tighten rates to curb inflation, which will then again push up the yields. It becomes a little bit of a pickle that we might get into. Again, I'm not saying all this will happen, but it's my job as a trustee of people's money to worry about these things. I don't live in Kaku land as a fund manager. So if oil goes to 70, 80, 100, we will be, India suffers. I mean, you don't need me to be telling you this. Everybody on the street knows this.
Oh, yeah, I mean, absolutely. As they say, in markets especially, better to be a worrier than a warrior. Shankar, it's always a pleasure. Thank you very much for joining us. You know, we put up Shankar's fund performance on the side, and we'll just sort of leave off with that. Great performance, Shankar, by the way, across your global funds and India funds, and we'll wish you all the luck to you and your team that the performance continues.